Hello guys, welcome. This is Deepika from wealthandhealthmastery.com, and in today's video we are going to see what are the ways of investing in stock market in the year 2024. So in this video I'm going to give you 8-step guide to start investing in 2024. The number one step is you need to have clear and concise investment goals. Now, what are your goals for investment? Are you interested to make money to retire early? Are you interested to buy a home or buy a car, going out for a vacation or plan for the wedding? So what are your investment goals? Why do you need the money? So you need to have a clear goals defined and prioritize. Your goals should be very concise, not vague. You should not be saying, hey, retirement, planning for retirement. You should say things like, I need this much money by the year 2027 for retirement. So that is how the goals should be defined. So having a concise goal is very important. That is the number one step. Number two step is how much money you can afford to invest. Everybody makes different kind of money, right? And everybody has different expenses. So how much percentage of your income are you willing to put towards investment? The rule of thumb says if you're making $100, let's assume that $50 goes towards your expenses. Let's probably owning a car, owning a home, your mortgage payment, your medical expenses, etc. Right? So this is $50 goes towards your expenses. Now the remaining 50% or the remaining $50, out of that $30 should go towards your investment. It could be any kind of investment, like investing in stocks, investing in real estate, investing in gold, etc. And then remaining 20% is towards your emergency fund. This is the fund that you're going to be using if some emergency comes. Let's say you lost a job, or sometimes there is a medical expense came in, right? So that is emergency fund. And after you have built up of 6 months of emergency fund, then you should start putting that 20% of your money back into investing. So 50-50 should be your goal. 50% towards your expenses and the remaining 50% is towards your investment and savings. So that is the rule of thumb says. You need to also start paying your high interest credit card. So if you have credit cards that you're paying off of and you're paying 15 to 20% interest, the first thing you need to do before you start investing is to pay off those credit cards. Then the important thing is prepare a budget for yourself. You should definitely know how much money you're bringing to the table, what are the different ways of bringing of the money that you're making, and also where are you spending money. You should have a budget that you review it every month to see your expenses and to see your income. That is the number 2 step. Number 3 step is determine your tolerance for risk. How much risk are you willing to take in the stock market? Because stock market is not always going to go up. Stock market has its ups and downs, and sometimes it can go up and sometimes it can go down. So if let's say you bought a stock for $100, tomorrow it might go to $80. It can happen. But you should not panic. So you should understand what is your risk tolerance. How much risk are you willing to take? Are you going to be a conservative investor who is going to be investing in those companies which are very strong or a blue chip companies? Or are you somebody who's going to go after growth stocks which are more volatile? So you need to define your risk strategy. How much risk are you willing to take? There might be a possibility that you spend $100 and the next day you lost all the $100. It can happen in stock market depending on where you have invested your money. So determine your tolerance for risk is the third step you need to keep in mind. The number 4 step is determine your investing style. So there are 2 ways of investing, right? One is do it yourself, and the other ways is to get somebody's help, like to have financial advisor at your side. Now, if you are investing yourself, then there are 2 ways of investing. One is active investment and the other one is passive. Active investment means where you're buying your stocks, individual stocks, you're buying it on your own, you're selling it on you're based on your own expertise. That is your active style of investing. And then passive style is, let's say you bought a index fund and you just contribute every month towards that index fund. So that is a passive way of investing. So let's say you bought an S&P 500 index fund. So that is the one way of investment, is passively. Now the other way is through the financial advisor, where they'll take a percentage of your money to start investing on your behalf. So that if you need somebody's help, you have companies like Charles and Schwab to provide you these financial advisor experts. So then the next step is determine your investing style. Number 5 is choose an investment account. So there are different types of investment accounts that you can open, or the brokerage account you can open through which you can start trading. So there are 3 types of accounts: taxable accounts, tax deferred accounts, and tax tax-free accounts. Now, what is the difference between these three? Taxable accounts, these are common for online trading. Brokerage accounts don't have tax benefits, but you can contribute and withdraw freely. Tax deferred accounts, contributions to traditional IRAs and 401ks reduce taxable income and taxes are postponed until withdrawal. Tax-free accounts, Roth IRAs and Roth 401ks are funded with after-tax money. Withdrawals in retirement are tax-free if they meet certain requirements. So these are the three types of accounts you can open. Now, the next important step is to fund your account. Now, once you have opened up a brokerage account, you have to fund your account. Either you can connect it with your bank account, or you can deposit a check, or you can transfer from another brokerage account to your brokerage account, right? So that is the three ways of funding your account. Once you have funded your account, then the next is decide on what type of stocks to buy. So there are different categories of stocks that you can buy. You have blue chip stock. Those are the stocks that are basically the stocks of big companies like Apple, Google, Microsoft. Those are blue chip companies which have a stable growth, but those are very stable and non-volatile stocks. Then you have is dividend stocks, stocks that give you money for holding those stocks. So companies like AT&T or Chevron, ExxonMobil, they give you dividends, or Walmart gives you a dividend of holding that stock. So the growth of the company is going to be less because it's a dividend stock, but you are still making money by holding that stock, and also you will see growth as well. So that is the second type of stock, is dividend stock. Then the third is defensive stocks. So defensive stocks are the stocks that are less volatile. For example, stocks of energy companies, because you need energy, or consumer goods like Walmart, etc. And companies like Chevron, ExxonMobil, these are defensive stocks because you need gas, you need consumer goods, you need electricity. So these are defensive stock. Number 4 is exchange traded funds, or ETFs. So that is you can invest in ETFs also. They work like stocks, but you investing into multiple companies by buying these ETFs. So that is the number 4. And number 5 is growth stocks. So companies like small cap or mid cap, these are the companies that are going to see a lot of growth, but they are more volatile because the stocks of these companies can go down as well, because companies can shut down. So that is the growth stock for you. These stocks have potential for significant growth, but they can be risky. Beginners interested in growth stocks should consider industries like technology or healthcare that have long-term potential. So those are the growth stocks. So then you need to decide what type of stocks you're going to buy. Then once you have decided on that, then you also need to monitor and review your investment. So you should not just completely forget once you have invested in stock. You should see how the stock of the company is doing, how the company is doing. You should look at their earnings report. You should check out their performance on a month to month or a regular basis. And then accordingly, you should change your investments based on what the company is doing or how your stocks are doing, right? So you have to monitor and review it on a regular basis to see and to change your approach if something is not working for you. So these are some of the steps that you need to follow in order to start investing in 2024. I hope you enjoyed these steps. So just to recap, the number 1 step is define your goals. Number 2 is determine how much you can afford towards your investment. Number 3 is decide on your risk tolerance. Number 4 is investment style, determine your investment style. Number 5 is opening an account, brokerage account. Number 6 is funding that account through either transfer from other brokerage account or through your bank account. Number 7 is decide on what type of stocks you're going to plan on buying. And number 8 is monitor and review your stocks on a regular basis. So these are some of the steps that is involved in investment. I hope you enjoyed the video, and if you want to watch such kind of videos, don't forget to hit the like and subscribe button so you don't miss any videos from the channel. I'm going to see you tomorrow with another stock video. Stay tuned for that. Thank you very much.